If you're a young investor in India today, you're probably caught in a bit of a financial tug of war, right? On one side, you've got the time-tested advice from your parents, and on the other, a whole world of new opportunities just flashing on your phone screen. So where do you actually put your hard-earned money? Let's break it all down and find a clear path forward.
This is the big question, isn't it? It's the classic dilemma. Do you go with something you can touch, like a piece of property, or do you dive into dynamic things like ETFs, that's exchange-traded funds that track the stock market? In this explainer, we're going to get to the bottom of this and figure out what really makes sense.
To really get into this, let's meet our two investors. First up, we have Ramesh. He's our traditionalist. He believes that real wealth is something you can physically see and touch. And then we've got Suresh. He's the modernist, and he's absolutely convinced that the best way to build wealth is to put your money to work for you in the market.
So let's start by walking down Ramesh's path. This is the world of physical assets. You know, the kinds of investments that have been the absolute bedrock of wealth for generations here in India.
This one line from Ramesh pretty much captures the entire philosophy. It's all about security, permanence, and owning something solid, something concrete. It's a really powerful mindset. But the real question is, how do these assets actually perform when you look at the numbers?
Okay, first up is the king of tangible assets, property. Now, the big plus here is leverage. You can control a huge asset with a relatively small down payment. But the negatives are, well, they're pretty significant. The entry cost is massive, which locks out a lot of young investors, and it's what we call illiquid. Selling a piece of land isn't like selling a stock. It can take months, sometimes even years.
And then, of course, there's gold. It has immense cultural value, and it's a great thing to have for emergencies. But here's the thing you have to understand about gold. It's more of a wealth preserver than a wealth creator. It's a great hedge against inflation, but it's not an engine for growth. Plus, you have the very real problem of, storing it safely. Finally, we have the safest options. Things like fixed deposits and post office schemes. They offer near-perfect safety for your capital, which feels really comforting. But here's the catch that Suresh would point out. They often lose the race against inflation. Think about it. If your FD gives you 7% interest, but inflation is running at 6%, your real gain is just 1%. Your money is safe from being lost, but it's not safe from losing its purchasing power. All right, let's pivot and explore Suresh's world. This is the path of financial assets, where the goal isn't just to store your money, but to make it grow, hopefully exponentially. And this right here is the core belief of the modern investor. It's all about leveraging the power of the market, the power of compounding, to build real wealth. Instead of letting money just sit there in a passive asset, you're putting it to work in the economy itself. A really popular way to start is with mutual funds. They're fantastic because they give you instant diversification across lots of different companies, and they're managed by a professional. And through a SIP, a systematic investment plan, you can start with a very small amount each month. The main downside, you do have to pay a fee for that management, which is called the expense ratio. This brings us to Suresh's favorite recommendation, an ETF, an exchange-traded fund. A super popular one in India tracks the Nifty 50, which is basically an index of the 50 largest companies on the national stock exchange. You're essentially buying a tiny piece of all of them at once. The costs are extremely low because there's no active fund manager you need to pay. The trade-off, of course, is that you are right there with the market's ups and downs. So we've heard the philosophies from Ramesh and Suresh. Now, let's move past the stories and look at the cold, hard data. It's time to put these investment options right next to each other and see how they really truly stack up. Okay, here it is, a direct comparison of everything we've talked about. Now, don't worry about reading every single word. Let's just focus on a few key things. See that entry/exit ease row? Bank FDs are very easy, but look at property, difficult. Now, look down at the long-term outlook. For property, it's high if you get the location right. But for a Nifty 50 ETF, it simply tracks the overall growth of India's economy. This table really helps us cut through the noise and see the real trade-offs. Now, let's simplify that big table even more. Look at the huge contrast here. Ease of entry/exit. Property is difficult, and ETF is super easy. How about growth potential? While property can be high, but you have to be lucky and choose well, an ETF just tracks the solid long-term growth of the whole economy. And the risks? They're totally different too. Property has legal risks, and you might not be able to sell it, while ETFs have market risk. After looking at all of that, it's really tempting to just declare a winner, right? To say Suresh is right or Ramesh is right.
But the smartest financial minds will tell you that the real answer isn't about picking one philosophy over the other. So here's the most important takeaway of this entire discussion. The best portfolio isn't a battle between Ramesh and Suresh. It's a partnership. It's about combining the stability and security of Ramesh's world with the inflation-beating growth engine of Suresh's world. You absolutely need both.
And this is a brilliant illustration of how to actually start. First, you build your foundation. Use something safe, like an FD for an emergency fund. That's your Ramesh component. Then, you start your growth engine, even with a tiny amount, through a simple SIP in a low-cost ETF. That's your Suresh component. And over time, you can diversify into other things.
You know, the most powerful force in your entire financial life is time. Trying to perfectly time the market is a fool's game, but giving your money time to grow is the surest path to building wealth. So the only real question left is the one right there on your screen. What's your first step going to be?